Mike, is all of this being driven by a repricing in Fed expectations? Now the market's getting even more aggressive when it comes to what it's looking for from the Fed.
Yeah, it's part of the same process. It's the same story, only more so. I think that's where we find ourselves repeatedly this year. We've obviously repriced radically in the bond market. There's a general recognition out there, and I would think by Fed officials' own admission, it's a relatively narrow and uncertain path to a soft landing, and there's a lot to happen between whether we know we get there or not. All those things are the case. Today and yesterday, one of the things that stands out to me is how kind of orderly and mechanistic the selling is on the same angle. All the indexes, major indexes today are down the same percentage. It just seems like a real step back from equity exposure in general. It's been about valuation compression all year. It's not really about the real-time read on the economy or corporate earnings. And that process is tough to handicap exactly when it ends. We still, by the way, are trading above the lows from late January. That's not necessarily a virtue. It's just saying that we've been in this process for a while, and we've kind of repriced the bond market a lot as the stock market has gone sideways to down.
Two-year note yield, Lizanne, 2.7%. Is that significant, what Mike just said, that we have not broken below the January lows?
Well, we've seen a reflattening a little bit of the yield curve today. Financial concessions have tightened, and Mike talked about where the market is relative to where it was in early January. But I also point to the rally that started on March 8th, which lasted to the recent peak at the very end of March. For all the talk about, has the lift in the market, is it suggestive of a better economic outlook or a better inflation outlook? That was a very low quality biased rally. It was the non-earners, well down the earnings spectrum. It was a lot of the narrative-driven type areas of the market. And I think that was more about short covering and some bottom fishing, reversion to the mean, by what hadn't been working, as opposed to some, healthy underlying message that the market was giving. So I think the theme more broadly this year has been one of economic growth weakening, elevated recession risk, and you have 10 rate hikes priced in now, inclusive of 3 likely 50 basis points, and then the idea of a 75, and it's just kind of a witch's brew.
So with that in mind, Lizanne, it's no wonder you've seen groups like utilities and staples, real estate outperform. Do you stick with those groups, even though we have seen valuations get a little stretched here?
Well, that's the problem. You have a sector like utilities where the multiple is higher than the S&P. Utilities generally live in the value indexes, but that doesn't mean they necessarily offer value. As I've said, on this show, we've talked about it, Sarah. I think you can look for sort of defensive characteristics, using that term somewhat generically as opposed to having it automatically apply to what might be perceived as typically defensive areas. I think you can look for value, lowercase v value. You can look for quality, strong balance sheets, strong free cash flow year, positive earnings revisions, and apply that everywhere in the market, not just to sort of preconceived areas that either define defense or define value. I would have that more factor quality approach right now, as opposed to trying to pick a sector or two.